to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
This is another episode of Peachtree Point of View, and today we're fortunate to have Aneet Deshpande with us as a guest. And Aneet is with Clearstead, so he has a very unique view of just alternative investments, just given the amount of capital they have under management and how they allocate capital. But Aneet, maybe just to start out today, if you could just introduce yourself, give your background, and then I'd love to talk more just about alternative investments and how you're looking at different strategies and so forth. But before we jump into those questions, I'd love for you to give your background.
Yeah, Greg, thank you. And I appreciate the time today. Yeah, so I started in the business in the late 90s on the kind of traditional long-only asset management part of the industry with a quantitative asset manager. Hung around there, ended up graduating a little bit more in my career and running a trading desk for a large bank. And that evolved into more investment strategy, asset allocation, and then was fortunate enough to join Clearstead about 7 years ago, overseeing investment strategy and research and manager research and asset allocation as CIO here today. So the firm, as we sit here today, oversees around $62 billion in assets under advisement. Our client base is really on the private client side, focused around the ultra high net worth and family office segments. And then we have an institutional business, which is centered around endowments, foundations. Primarily, we do a lot of other institutional consulting as well, but OCIO for endowments, foundations, generally speaking, in the $50 to $300 million type asset base.
So, when you think about I think you said $62 billion that you have under management today, how are you allocating? Is a lot of that going into illiquid or alternative investments, or most of that into public type investments?
Combination. We're really a holistic advisor for, let's just start with the private client business where, we employ almost 50 CPAs. We have a very large financial planning and estate planning organization. We have a trust company or trust business. So we're really thinking about multi-generational investing around that sort of objective, and clients have a varying degrees of objectives, obviously. So when we engage clients, it's very much around the tax and financial planning and investments part of the relationship. And from there, how things ultimately end up in a client portfolio, it really, again, it gets informed by that financial plan and informed by taxes, obviously. We combine public and private markets, Greg. So you can think about a portfolio from our point of view. We look at the world through the lenses of growth assets, diversifying assets, and income and liquidity assets. And so for large clients, once you can get to a place where you're mitigating or asset liability matching their cash flows for some period of time, you have a model in which you can take those other assets and deploy those in primarily growth assets with some diversifying and income liquidity assets. So we do that specifically to not obfuscate the role of private markets in capital formation. So we look at growth assets as being both public and private equity. So the job of equity for a client is to grow the corpus net of inflation and taxes over time. And so the distinguishing factor there of liquidity is something you have to pay attention to, obviously, but they share that fundamental characteristic to grow the client portfolio. And the same is the case for public and private assets within, income liquidity, where you may be looking at private credit versus investment grade public credit. In diversifying assets, you may be looking at public real estate with private real estate, for example. So we do that to reduce the noise between the asset classes so that we're focused on the right things. And I think the word alternative loses sight of some of those specific key drivers for client portfolios.
So like the industry itself, if I feel like when you think about, wealth management, you think about registered investment advisors, you think about even other different allocators of capital, into these alternative investment strategies, there's been a huge movement towards these evergreen structures that offer, liquidity. Do you think that's a very sustainable strategy long term, or what's your view? Just given, because a lot of it's been in the news lately with private credit, and obviously there's mismatches between assets and liabilities, especially where you're offering liquidity and you have illiquid assets underneath those structures. But just curious your thoughts of the future as you think about the benefits and the disadvantages of some of these evergreen vehicles.
Yeah. Well, I think there's a big learning moment here. So I think there's some of the narratives that you hear in the public domain are that they're just unequivocally bad. I don't know that I would go there. I think, one, evergreen is a very broad category. So we're talking about tender funds, interval funds, both of which are 40 Act, although you can have non-traded or tender funds that are not 40 Act, non-traded BDCs, non-traded REITs. So you have a whole kind of host of different structures there. Where I think you're seeing a lot of the tension is specifically in direct lending, and that's specific to obviously the BDCs that are publicly traded and then non-traded BDCs, and then by extension the interval fund format. They all have their own set of circumstances. To say that there's uniform characteristic that's driving the tension, I think is a little bit misplaced. So you may have a very concentrated public BDC to second lien credits heavily exposed to the consumer that's going to behave very differently than a broadly diversified BDC or interval fund that has 4,000 middle market sponsor backed portfolio companies that are underpinning the portfolio. There's very different outcomes. So, I think the evolution of evergreen is good. There are certainly going to be bad players. There are bad players, I would say. I think it's one of these things where you have to say, where genuine evolution could become, an extension of bad behavior. And anytime you get into a vehicle that's designed around asset gathering, which you could say a lot of interval fund format funds are designed to do, that is going to cause problems, whether that's at the underlying portfolio level or with the investor base, not having the right investor base, for example. It doesn't matter how careful you are in the design of this underlying portfolio. Even if you have the best liability management of that structure, you could face consequences. And some of this is around this desire to be able to offer investors, a 5%, for example, structural liquidity optionality, by the quarter, just as an example. And those kinds of things create problems, and you're seeing that now. And so I think one of the questions we ask ourselves are gates a feature or a bug? We think of them as a feature because it protects investors. The reality is, I think most clients and a lot of advisors think of them as a bug. And so that's a tension that has to get resolved that I think the market's trying to solve for right now. So only in this environment can you have a lot of high quality assets with low distress levels and low default levels and PICs rising and a lot of weird things are going on, I would say. Not weird, but cyclical things are going on where you could have a healthy portfolio and be on the front page of a paper. And that's the dynamic that we're kind of dealing with right now. And nobody wants to spend, I don't think anyways, advisors want to spend 2/3 of their hour allotment with the client talking about 3% of the portfolio. Easy to get in, hard to get out. And so that's part of the conundrum.
So just knowing that as a backdrop of what's happening, and to your point earlier, a lot of this is centered around private credit today. A lot of the noise has been in private credit with their evergreen vehicles and the ability for potentially you can redeem up to the 5% or to some level where they're putting up their gates, and obviously that's causing heartburn with a lot of investors. But I guess, is there better, from your standpoint, if you're creating a structure for private credit today within commercial real estate and even outside of real estate, is there a better mechanism from your standpoint? Or how would you look at it, just given that, going back to what we talked about, the mismatch of just, assets and liabilities, knowing that usually within private credit, most of the underlying assets are truly illiquid.
Yeah. Yeah. So, and I should have said this before, we're as a firm philosophically very much exposed and interested in the traditional drawdown structure. So closed-end funds, we think, just create a better asset liability match. The one thing that I would say is a key differentiator there is you don't have to worry about the investor base. The LP base may matter, but it can't really kill you in the way where the investor base has to be really well understood in let me just say evergreen writ large. So that's something you really have to pay attention to. It's something that we underwrite when we look at evergreen products. In terms of design, Greg, to your question, I think so much of that is intrinsically linked to the asset gathering strategy of a sponsor or an asset manager. Clearly, people are doing this because it's a quick race, right? Like you can get into market. There are a lot of positive things that the industry has talked about or attributes of why interval or evergreen, let's just say again, is good. And that includes things like getting immediate exposure, continuous compounding instead of going through the problems of committed capital, getting exits, realizations, having DPI problems, or having to worry about a separate set of consequences. And then obviously you have varying degrees of investor access and then liquidity. And so you have to underwrite each one of those things. And I think as we've done that over time, we just keep coming back to drawdown is more appropriate for private investments. There are some asset classes where evergreen work. And then we have to ask ourselves, well, what do you mean by evergreen? And we've seen institutional evergreen, for example, both in private credit, real estate, where the investor base is more controlled. It's not being slung across the masses or being sold for pure asset gathering. It's more of a design of a better vehicle for the existing LP base and the investments. So those are the questions I think that you have to ask. I think ultimately we all know the not the naysayers, but the critics would say that if you're just simply using these to democratize in the spirit of asset gathering, we all know this, and I've had this conversation a dozen times in the past month. Tickerizing something is so much different and easier than having a simplified subdoc or just an extended subdoc. And naturally, if you ask somebody that has 100 clients, are they going to go through the process of filling out 100 subdocs for their clients? Or just hitting the button once across 100 clients for a tickerized interval fund? Clearly, the latter is going to take precedent there. So the
Right.
operational ease, I think, is something that the advisory industry has looked at as solving a problem, essentially, getting access. And the questions we have to ask around that are, is that democratization or access? Is that coming with some unintended consequences? And we think the answer is yes, but I think it's overblown. I think the FT, the journal, there was some press today about the hedge fund that had tendered Blue Owl and a couple of others. And, I just don't think the stresses are as endemic as people are making out to be. And people will get rational, but I do think we've raised a lot of money in direct lending, for example, in the interval fund format, and there's going to be some consequences there.
Yeah, I would tend to agree with you. I think, we're a big believer in the drawdown, structure, the close-in type vehicles. It's very hard to match, liquidity when you have illiquid assets, underneath those structures. When you have, some of these evergreen structures, I think there's ways to do it. It's very challenging for the manager, and it can just set the investor up for outcomes that may not be what they originally signed up for, or they may not be getting paid for the risk. They may be they may be underappreciating the risk associated with some of these structures. And that's where I think, from our perspective, I think that's the biggest challenge, is making sure if the investor's investing into it, they really understand that it's really just an illusion of liquidity. It's not true liquidity. And that could change how they would allocate their capital accordingly.
And Greg, that's so true. And just one more kind of quick point on that. There are so many people, I think a lot of people, requalify that are getting into the registered product game that don't necessarily have the experience of having done that. It's one thing to have the experience having managed the asset class over cycles. It's quite another to say that you've done that within a product that has varying optionality for investors. And if you look at the Dalbar QAIB study a week and a half, 2 weeks ago, or Morningstar's Mind the Gap study, we all know about investor behavior. There's a reason why the average investor experiences, percentage points different than the index. And it's because a lot of it is because of behavior. And the minute you introduce behaviors, the minute you have different considerations for how you actually build and manage that fund. And it just goes back to like having it on paper and it looking very good, to the practical nuances of running a product that is open for daily subscriptions, monthly exits, or whatever the characteristics are, and then promising liquidity where you can take in money and obviously put the gate up on the way out. So I think those are very important qualifiers here for underwriting also.
Given your knowledge, your experience, everything you're seeing in today's market, there's a lot of volatility. As a company at the Peachtree side, we typically invest across commercial real estate. We do a lot within credit. We also do a lot across the equity side as well from time to time, across commercial real estate and hotels and so forth. But if you had $100 million of capital to allocate specifically within real estate, how would you allocate that today?
Yeah, I mean, I'm a generalist. It's hard, so I think that's the background here. It's not coming from a place of spending, hours and weeks and months inside of a, deep expertise of an asset class. So we're solving, client problems, whether it's multi-generational or for an endowment foundation, just use a CPI +5 type mandate. So a lot of the way we look at the market is informed by those two things. Again, heavily informed by financial planning and tax planning for private clients, heavily informed by what are the goals and objectives for an institution. It's the preamble to say that for as we think about both debt and equity, they play different roles in the portfolio. And so I don't know that it's one or the other. I think they both have a place in portfolios. Real estate credit looks pretty interesting from everything that we've seen and talked to in terms of managers, including Peachtree. On the equity side, I'd say there's a lot of also interesting things. Real estate had its moment 3 years ago, 4 years ago in that down cycle. And I think people are still a little bit gun shy there. And when you're holistically planning, a practical constraint or conundrum that we have to walk through is you want to be very holistic and look at clients' full exposure to an asset class. That includes any small businesses they own or closely held businesses that they own. That includes their personal properties, their second properties, their third, fourth, their investment properties. And when you do that look through, you can arrive at conclusions of where real estate plays. It's very different than other asset classes, which I think is one of those nuances with real estate. But yeah, I mean, I think commercial looks very interesting. I think both on the credit and the debt side. And again, I think people are a little bit paralyzed isn't the right word, but I think there's just so much attention to ABL, so asset-based lending, to middle market and upper market direct lending on the corporate credit side, and less kind of attentive to real estate debt, for example, or credit just writ large. I think there's probably some validity to opening that argument away from where I think capital has flown. And I'm not suggesting like that's going to stop, that's going to keep going, but widening the aperture to include real estate again seems like a logical place to be.
Yeah, no, that's great insights. And I do think, I think across real estate, it is interesting, especially within commercial real estate today, because to your point, 4 years ago, values had reset. I don't think values fully reset. Has made the equity trade, very, very challenging. Credit has been compelling across commercial real estate, just given in a lot of cases, you can get yields that are very similar to what traditionally you've gotten by investing on the equity side, but you can invest in a more defensive position through credit. But then just given supply constraints across most property types over the last several years, and just given the revaluation across assets that's still happening as we just continue to recalibrate to this higher for longer long-term interest rate environment, it's definitely created some interesting opportunities on the special situation sides and the credit side. But with that said, I know we're running out of time. Aneet, I just want to say thank you for joining us. We really appreciate your insights. This is just another episode of Peachtree Point of View. So thank you for everyone that tuned in today.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.